You've probably heard someone say, "I wish I had started investing earlier." Almost every successful investor says that at some point in their life. They're not talking about secret stock tips or lucky guesses. They're talking about understanding the basics early and staying consistent long enough for money to do what it naturally does over time. Let me start with a real story. In 2008, during the global financial crisis, a schoolteacher named Sarah watched the stock market collapse on the evening news. Every night, the headlines were full of fear. Friends at work were selling their investments and swearing off stocks forever. Sarah felt the same anxiety. She didn't have a finance degree. She wasn't a professional investor, but she had something powerful, a plan. Instead of pulling her money out, she kept investing a small amount from every paycheck into broad stock funds. No guessing, no chasing hot stocks, just steady, boring consistency. Years later, while many people who panicked were forced to start over, Sarah's portfolio recovered and kept growing. She didn't get rich overnight, but she built financial security, confidence, and peace of mind. That's the quiet power of investing done right. Investing in stocks simply means buying a small piece of a real business. When you buy a stock, you become a partial owner of that company. If the company grows, earns more money, and becomes more valuable over time, your ownership stake grows with it. If the company struggles, the value of your investment can fall. That's the trade-off. Growth potential always comes with risk. This guide breaks investing down into 7 clear steps so you can start with confidence, even if you're beginning with a small amount. Step 1 is setting clear investment goals. Before you invest a single dollar, you need to know why you're investing. Not in a vague way like, "I want more money," but in a specific and meaningful way. Are you saving for a home in 5 years? Planning for retirement decades from now? Building long-term wealth so you can have more freedom in your life? Your goals shape every decision that follows. Short-term goals usually require safer, more conservative strategies. Long-term goals allow you to take more risk because you have time to recover from market downturns. Your life stage matters too. Younger investors typically focus on growth because time is on their side. Investors closer to retirement often focus on preserving capital and generating income. Neither approach is better. The right strategy is the one that fits your situation. It also helps to put numbers and timelines on your goals. Saying you want to retire comfortably is abstract. Saying you want to accumulate $500,000 by age 50 gives your plan direction. And remember, financial planning isn't static. As your life changes, your goals should evolve with it. Step 2 is deciding how much you can afford to invest. This step requires honesty. Investing should improve your life, not create stress. Start by reviewing your income and expenses. Look at how much money comes in and how much goes out each month. Before investing, it's wise to have an emergency fund. This doesn't need to be perfect, just enough to cover a few months of essential expenses like rent, food, and utilities. This safety net protects you from having to sell investments during market downturns when you need cash. High-interest debt deserves attention too. Credit card debt in particular can grow faster than most investments. Paying it down is often a smarter move than investing while interest is piling up. Once those basics are handled, decide how much money you can invest consistently without affecting your daily life. You don't need a large lump sum. Many people start with a small weekly or monthly amount. Investing is a long journey, and consistency matters far more than how much you start with. Only invest money you won't need in the near future. This simple rule protects you from emotional decisions and financial strain. Step 3 is understanding your risk tolerance and investing style. Risk tolerance is about how comfortable you are with uncertainty. Markets move up and down. Some people can watch their investments drop temporarily without panic. Others lose sleep when they see red numbers. Knowing which type you are is critical. Your risk tolerance depends on your time horizon, your financial cushion, and your personality. If you're investing for a goal that's decades away, short-term drops matter less. If you have stable income and savings, you can usually take more risk. If uncertainty causes anxiety, a more conservative approach may help you stay invested. Investing style matters just as much. Some people enjoy researching companies and tracking performance. Others prefer a hands-off approach. You can manage your own investments actively by buying and selling individual stocks. You can invest passively by buying broad market funds and letting them grow over time. You can work with a financial advisor for personalized guidance, or you can use automated platforms that build and manage portfolios for you. There's no single right choice. The best style is the one you'll stick with consistently. Step 4 is choosing the right investment account. The type of account you use affects taxes, flexibility, and long-term return. A standard brokerage account offers full control and easy access to your money, but you pay taxes on gains and dividends. Retirement accounts are designed for long-term growth and offer tax advantages. Some reduce your taxable income now and tax you later. Others require you to pay taxes up front, but allow tax-free withdrawals in retirement. There are also specialized accounts for education and healthcare that come with unique benefits. When choosing an account, pay attention to fees. Trading commissions, maintenance fees, and account minimums can quietly reduce returns over time. Many modern brokers offer commission-free trades and no minimum balances, making it easier than ever to get started. Look for a platform that's easy to use, well-regulated, and secure. Strong customer support and educational resources are valuable, especially for beginners. Step 5 is funding your account and building consistency. Once your account is open, you need to fund it. Most people do this through bank transfers. Some transfer funds from an existing brokerage. Many platforms also allow automatic contributions. Automatic investing is powerful because it removes emotion from the process. By investing a fixed amount regularly, you avoid trying to time the market. You buy more when prices are low and less when prices are high, without overthinking it. This habit alone puts you ahead of many investors who let emotions drive their decisions. Step 6 is choosing your investments. Beginners often feel pressure to find the perfect stock. In reality, stability matters more than excitement when you're starting out. Large, well-established companies tend to offer steady growth. Dividend-paying companies provide regular income that can be reinvested. Defensive industries often hold up better during economic downturns. Exchange-traded funds are especially beginner-friendly. They allow you to invest in many companies at once, reducing the risk of relying on a single stock. Broad market funds track indexes that represent large portions of the economy, giving you diversification and simplicity. History shows that over long periods, diversified market investments have outperformed most attempts to beat the market through active trading. Slow and steady often wins. Step 7 is learning, monitoring, and reviewing over time. Investing doesn't end once you buy your first stock. Successful investors continue learning. They stay informed about markets and review their goals regularly. That doesn't mean checking your account every day. It means making thoughtful adjustments when your life or goals change. Reading reputable financial sources, understanding diversification, and reviewing your portfolio periodically helps you stay on track. Avoid anyone promising easy or guaranteed returns. Investing rewards patience, not shortcuts. You might wonder how much money you need to start investing. Today, the answer is less than ever before. Many platforms allow fractional shares and low minimums, making investing accessible to almost everyone. Stock funds and ETFs are particularly useful for beginners because they simplify decisions and spread risk. Over time, watching how these investments move helps you understand the market's natural ups and downs. Every investment carries risk. Values fluctuate. Returns are never guaranteed, but risk can be managed with diversification, time, and discipline. You don't need perfect timing. You don't need special knowledge. You don't need a large amount of money. You need clear goals, a realistic plan, and the patience to let time work in your favor. That's how investing turns from something intimidating into a tool that quietly builds your future.